Welcome to the Opening Bell Report.
The pain I'm talking about today is watching a company, a company you probably use every single week, just get absolutely pummeled.
Day after day.
Day after day. While everything else is flying, this one stock is just drilling into the center of the earth.
It's that value trap anxiety, right?
Yeah.
You feel like you're the only sane person in the room seeing this value, but the entire world is screaming, "Get out, the building is on fire."
And that is exactly where we are today. We are looking at some research on what might be the single most hated stock in the S&P 500. The retail crowd is gone. The analysts are cutting targets.
It feels like it's been left for dead on the side of the road. The sentiment is. It's just brutal.
But the analysis report we have argues this exact company is sitting on a powder keg of potential.
A huge potential.
We are talking about PayPal, ticker symbol PYPL. And just to set the scene for you, as we're talking, the stock is trading around $56, $57. It's hovering just dangerously close to its 52-week low. It is ugly.
Oh, the chart looks like a falling knife. Nobody wants to try and catch that.
So here's our mission for this deep dive. We've got this very specific, very contrarian report in front of us titled The PayPal Bull Case. And we have to figure out this discrepancy. The market is screaming, sell, legacy dinosaur.
And this analysis is saying this might be the dip of the decade. It's that classic battle, market narrative versus, the fundamental math.
But I have to play the skeptic today, because that narrative is loud for a reason. People are saying fintech is dead. They say Apple Pay won. So help me understand. Are we looking at a bargain, or are we just trying to catch that falling knife?
That is the multi-billion-dollar question. And to answer it, we have to ignore the stock price for a minute. But you're right, we can't talk about the upside until we honestly confront why everyone hates this stock.
Yeah, let's start there, the bear case. Why is this sentiment so toxic? I mean, I still use it. It works. But Wall Street treats it like it has a contagious disease.
It is toxic. And if you read the bearish sections of the analysis, it really all boils down to one single existential fear.
Irrelevance.
Irrelevance, the dinosaur factor. It's the elephant in the room, which is really two elephants, Apple and Google.
Right.
The prevailing story on the street is that Apple specifically is eating PayPal's lunch.
I get that. I mean, double-clicking the side of my iPhone to pay it's just so slick. It's almost impossible to beat that native integration.
It is. And every time you tap that phone, that's a transaction that, in an investor's mind, PayPal isn't getting. The fear is that PayPal's core product, that little yellow branded checkout button,
The one we all know.
is just slowly losing its grip, slowly losing market share.
So it's a slow bleed. Not that they're going to blow up tomorrow, but that they just die by 1,000 cuts.
Precisely. And that fear directly feeds into the second point the bears hammer on: growth.
Or the lack of it.
Exactly. The report highlights that PayPal's revenue is growing at about, 7%?
7%, okay.
Yeah.
Most businesses would kill for that. But in the world of big tech, that sounds sleepy.
It's pedestrian. You look at NVIDIA, these AI darlings posting 50, 100% growth. So when Wall Street sees a tech stock growing at single digits, they just punish it. They say, this isn't a growth stock anymore.
It's a utility company.
Right, like a waterworks or something. Steady, boring, no upside.
Okay.
And it gets worse. To even get that 7%, the report points out they've had to rely more on your unbranded processing, stuff like Braintree.
Which powers Uber and Airbnb, right? But it's in the background.
Exactly, it's the plumbing. And the profit margins on that are much, much lower than the classic PayPal button.
So you've got this margin anxiety. Slow growth plus shrinking margins.
Equals a stock price that gets absolutely crushed. That's the bear thesis in a nutshell.
So the market is pricing this thing as if its best days are firmly in the rearview mirror.
Yes, the market is pricing in fear, plain and simple.
Okay, that's the gloom. That's why we're at $56. But now let's pivot, because this PayPal bull case report looks at that exact same data and sees something totally different. It claims the valuation is, and I'm quoting here, broken.
This is where it gets really fascinating. If you just strip away the emotion for a second, forget Apple Pay, and look at the cold, hard math. The report points out that PayPal is trading at a price-to-earnings ratio, a PE of 11.4.
Okay, wait, hold on. Let's just unpack PE of 11.4 for everybody. Why is that specific number so important? Why is it screaming broken to the person who wrote this?
Think of it like a price tag. It's the price tag for a company's profits. So you're paying about $11.40 for every $1 of earnings the company makes.
Got it. So lower is cheaper.
Right. And for context, the S&P 500 average is often over 20, even 25. Some tech stocks are 50, 100. So PayPal is trading at a 50% discount to the average company.
Wait, half as expensive as the average stock, including like Campbell's soup.
Yes. And the report makes an even starker comparison. It says at 11.4, PayPal is cheaper than most big banks. It's cheaper than many utility companies.
That's wild. A global digital payments platform is being valued worse than an electric company that can only serve one city.
That is the core of the argument. The report calls this priced for bankruptcy.
That seems a little dramatic.
It is a dramatic term, but it describes the reality. When a stock gets this cheap, the market is essentially saying, we don't believe these profits will last, we think they're going to collapse.
But they're profitable.
Yeah.
Extremely profitable. They aren't burning cash like a startup.
No, they are a cash machine, and that's the anomaly. The thesis is that the market is just wrong about the durability of PayPal. Even if growth stays slow forever, the price is simply too low.
So the downside is capped because it's already priced like it's dying.
Exactly. You're buying at what looks like a floor. And this sets up what the report calls mean reversion.
Returning to the average.
Just returning to normal. If sentiment shifts even a tiny bit from dying to just doing okay, the stock could jump 20 or 30% without any huge growth news.
It's like a coiled spring.
Boom.
Okay, so the valuation is weird, but you usually need some kind of catalyst to change the story. And this is where the report threw me a total curveball. I thought I knew the PayPal story, but I completely missed this.
Ah, you're talking about the January update.
Yes,
Yeah.
the hidden catalyst involving Google.
Yeah.
Something called the Universal Commerce Protocol, or UCP. What is this, and why does the report say the market is completely blind to it?
This is critical, and it's a little technical, but let's break it down. We all know AI is the big buzzword, but PayPal has been quietly working on the plumbing for how AI will actually spend money.
Explain that, because if I ask an AI to buy me a pizza right now, it can't actually do it.
It can't. That's the agentic commerce gap. In the near future, you'll tell your AI assistant, hey, book me a flight and buy that jacket I liked. But the AI hits a wall. It hits the credit card form, the "Are you a robot?" CAPTCHA.
Right, the AI doesn't have a wallet.
It doesn't have a wallet, and it doesn't have an identity a merchant can trust. Enter the Universal Commerce Protocol. PayPal announced support for this standard. Effectively, they are positioning themselves to be the trusted wallet for AI agents.
Whoa. Okay, let me connect the dots here. So while everyone is worried about Apple Pay winning the phone war, PayPal is trying to become the default payment layer for the AI war.
That's it exactly. While everyone's fighting the last battle mobile tapping, PayPal is digging into the next one, agentic commerce. They have the data, the fraud detection, to be that trusted layer.
And the report says the market just shrugged.
Completely ignored it. The stock didn't move. The analysis argues that investors are so obsessed with the daily price wiggles that they're missing this huge future revenue stream.
So at $56 a share, you're getting that for free.
That is the argument. You're paying a discounted price for the old business, and you're getting the AI wallet option for $0. It's a free call option on the future.
That really flips the dinosaur narrative on its head. The dinosaur is building a spaceship in the garage.
Or at least the fuel lines for everyone else's spaceships.
Fair enough. But let's get back to the numbers. Because as cool as AI is, it doesn't pay the bills today.
Yeah.
And the report has a section called the profit engine. Financials don't lie.
And numbers are the antidote to sentiment.
So revenue growth is slow. 7%. We know that. But what about profit?
This is where the dying company story just falls apart. While revenue is up 7%, net income is up 24%.
Wait, 24. How do you grow profits 3 times faster than revenue?
Efficiency. The new management team has been laser focused on cutting fat, streamlining, getting leaner.
Okay.
They brought in over $1 billion in net income in 1 quarter. It's a cash machine. And that leads to the other big number, free cash flow, $6.7 billion.
And just to clarify, free cash flow is the money left over after all the bills are paid, right? This is the cash they can actually give back to owners.
Exactly. It's the real stuff. And the question is, what are they doing with it?
Right. Are they just sitting on it?
No. And this is the most bullish signal in the report. They are using that cash for aggressive share buybacks.
Buybacks. We hear this all the time. But explain why it's such a big deal at this price. Why is this better than, say, a dividend?
Okay, let's use an analogy. Imagine you and I own a pizza shop. It makes $100 profit. We split it 50-50.
I like pizza. Go on.
Now, I want out. But because everyone's scared of pizza right now, I sell my share back to the business for a really low price. The business buys my half.
Okay, so now I'm the only owner.
Exactly. The shop still makes $100 profit the next day, but now you get the whole $100. Your earnings per share just doubled, even though the business didn't sell a single extra pizza.
I see. So by buying back their own stock when it's cheap, they're reducing the number of slices in the pie.
Your slice just gets bigger. Management knows their stock is trading at 56, but they believe it's worth 80 or 90, so they are aggressively buying out the scared investors at a huge discount.
They're taking advantage of the market's fear.
Pretty much. And it puts a natural floor under the price because you know there's a massive guaranteed buyer in the market every single day. the company itself.
They're betting on themselves when no one else will.
And that action speaks way louder than some analyst rating.
Okay, so to recap the bull case so far, a historically cheap valuation, a hidden AI catalyst, and a cash-rich company buying back its own stock like crazy.
That's the fundamental trifecta.
But we have to talk about the chart, the technical analysis. The report has a section on the setup.
Yes, and this part's pretty clear. The report identifies $56 as a critical level. It's a multi-year floor.
A floor, meaning the price hits it and it tends to bounce back up.
Exactly. It's acted as support multiple times. Sellers get exhausted, value buyers step in, and it bounces. The report identifies the current pattern as a double bottom.
Which is usually a bullish signal, right? Can you visualize that for us?
Think of the letter W. The price goes down, hits a low, bounces, goes down to that same low again, and then shoots up. We're at that second low point right now.
And what's interesting here is the risk-to-reward ratio the report lays out.
Hugely important. Because we're so close to that floor, the risk is tight. The report suggests a stop loss just below $55.
So if it breaks below that, the trade is busted, you get out, you admit you were wrong.
Exactly. You protect your capital. So you're risking maybe $1, $2 per share. That's your risk.
And the reward.
The target is a simple return to fair value, back to the 200-day moving average, which is around $75 to $80.
So you're risking about $1.50 to potentially make 20.
It's better than a 10-to-1 risk reward. That is a lopsided trade in your favor.
And what do the Wall Street analysts actually think?
This is the funny part. Even the bears aren't that bearish. The lowest target on the street is $51. That's only about 10% downside from here.
So even the haters think it's pretty close to the bottom.
Right. But the average analyst target is around $74, $75. That's a 31% upside. And the high target is over $120.
So the consensus is the downside is limited, but the upside potential is huge.
That's the conclusion. Limited risk, but if anything goes right, a little sentiment shift, better margins, AI adoption, the ceiling is massive.
It's a classic contrarian setup. You have to be willing to look stupid for a little while.
That's value investing. It's uncomfortable. You have to buy the thing that makes your stomach turn.
Buy when there's blood in the streets, even if the blood is just bad sentiment.
Exactly.
So let's wrap this up. The tension is clear. On one side, you have this hated stock. It's boring. Maybe it's a dinosaur. The growth isn't setting the world on fire.
And on the other, you have massive profitability, billions in cash flow, a sneaky AI play, and a valuation that is literally half of the broader market.
It's emotion versus math.
It is. And the report closes with a sentiment that I think is really powerful. The author says, I'm not waiting for $80 to buy. I'm buying when it hurts at 56.
Buying when it hurts. That's the hard part.
It is. But as the report asks, are you betting on the emotion of the crowd? Or are you betting on the cold, hard math of 11x earnings for a global payments giant?
That's the question we will leave you with. Something to chew on next time you check out with that little yellow button.
Absolutely.
And just a quick reminder for everyone listening, we're analyzing a specific report here. This is not financial advice from us.
Do your own homework, always.
Thanks for diving in with us. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.